This is your brain on risk. This is Mind Over Money, the podcast where Kevin Cook exposes the psychology of investing.
Welcome back to Mind Over Money. I'm Kevin Cook, your field guide and storyteller for the fascinating arena of behavioral economics. With the advent of large language models, or LLMs, there's a legitimate concern that people will stop doing their own deep research. From high school and college kids fudging on their papers to traders and investors getting their financial education from social media. In fact, in the conversations I have on X these days, I would say there's an epidemic of those getting their minor in macro from YouTube. But you don't need a degree in economics to become a good investor or trader. What you need is math skills. I've said for decades that probability training is the antidote to behavioral biases that typically make our money disappear. So imagine me at 29 years old, walking into the trading pits of the Chicago Mercantile Exchange, still allergic to algebra like I was in high school and college. But I was captivated by the raucous action on the trading floors where the average Joe and Jane from Chicago could play 3D chess with global markets in Japanese yen, pork bellies, and T-bill futures. And because I wanted to stick around, even though I was making only $6 an hour as a clerk, I hit the books, specifically the sacred texts of trading, Jack Schwager's Market Wizard series. The one strength I brought with me into the pits was my love of reading. So I dove into the Market Wizards, which are all almost entirely based on tape-recorded interviews that Schwager did with successful commodity, futures, and currency traders of the 1970s, 80s, and 90s. The interviews read like fireside war stories. There's Richard Dennis, for instance, who started in soybeans and went on to run a fund that did a big chunk of S&P futures volume. He is probably most famous for training the turtles. And Paul Tudor Jones, who started trading cotton for his family at the New York Merc and is still doing global macro, and you see him on CNBC. Then we have the dynamic duo of George Soros and Stanley Druckenmiller, who infamously broke the Bank of England in 1992. There are a dozen more worth mentioning, but I've only got a few minutes here. My main point is that after reading the first two books, I identified several common themes that I call the 6 keys to the kingdom. They are psychology, risk management, systems, consistency, discipline, and probability. And there was my Achilles heel with that last one, math. So what did I do? Well, I found more books. Not only was I reading about the complex connections between CME currency and interest rate futures and the global FX and bond markets, I was trying to understand the math of why soybeans, British pounds, or live cattle traded at a premium or a discount in the future. It wasn't easy for a kid who got queasy from equations to grasp concepts like cost of carry. But more importantly, I had to learn the most basic math of probability. And I did that by reading the 375-year-old story of a Renaissance gambler, the Chevalier de Mer, who knew the polymath Blaise Pascal and brought him a conundrum. The Chevalier was also, his real name was Antoine Gombad. He offered wagers to daring souls with dice. And he couldn't figure out why one bet, rolling at least 1 6 in 4 throws of a single die, was less likely than the second bet, rolling at least 1 double 6 in 24 throws of a pair of dice. By his rough calculations, those were equal bets. So he brings this to Pascal, and Pascal threw himself into the challenge by engaging his mathematical friend, Pierre de Fermat. And in a series of letters they exchanged in the 1650s, they solved the mystery and created the foundations of Monte Carlo and Wall Street, and obviously Vegas. This effort that I put in, the work to know how probability worked, inspired me to learn basic statistics. And these were foundational for understanding the Black-Scholes options pricing model and volatility dynamics, which furthered my career. That's how I built a career for myself in the late 90s and early 2000s. It was hard and confusing, though, with many accidental twists and fortuitous turns. But if I could go back in time, I wouldn't change a thing. It also ignited my passion for science, like evolution, astrophysics, and neuroscience. I'd always read books about these favorite topics, but now I could begin to understand the data measurements and stats that were crucial tools for the scientists doing the work and trying to explain their findings, to us lay people without a science background. I should add that part of my good fortune wasn't just in books, though. I was also in the right place and time for two other reasons. First, I was a clerk in a commodity options pit where I got to watch math geeks with pricing sheets work their magic making two-sided markets to paper, the incoming orders to the pit. They were primarily doing delta neutral volatility arbitrage, and I was fascinated to watch and learn in the pit and then try to simulate it on my own later with a simple computer program. Second, since Chicago was the birthplace of options trading for stocks, commodities, and financial futures, we had the best teachers around. One in particular was Sheldon Nattenberg, a math lover turned options trader who wrote the quintessential handbook, Options, Volatility, and Pricing. He also taught classes at the Merck, and I was lucky enough to take several. For me, it was total immersion with stories, experiences, and simulation, just like when my dad taught me to fly an airplane at 15 years old. In fact, I give my dad credit for teaching me how to think in terms of planning and contingency long before I applied those skills to markets. And that's why my personal mission for the rest of my days is to inspire as many kids as possible to find their passion for science and math. The world is changing very fast right now with AI. And, we can't be sure what jobs will still be here a decade from now or what new industries will be created. But having basic agility with science and math concepts and skills will always be crucial to navigate these landscapes. And since, the U.S. still graduates 75% of high schoolers below proficiency in math, I know there's a lot of kids out there like I was. Many just need a different way to learn the material. So imagine all the kids who might actually love science and math if only their internal spark of curiosity were ignited with alternatives to textbooks full of equations. I talk about VR and AR-driven AI for kids, and I actually pitched this idea to the National Science Foundation in 2017. And this is before ChatGPT. Some people said, yeah, you were channeling ChatGPT before any of us knew what an LLM was. In a sense, we are all like the turtles of Richard Dennis when we first start out, able to learn anything with the right instruction. I will put links to my youth STEM education projects in the article version of this podcast on Zacks.com. Or you can just email me, kcook@Zacks.com, if you want to learn more. And you can find my 2017 proposal to the National Science Foundation for a learning design engine using AI, VR, and AR at the pinned post on my X feed, at Kevin B. Cook. Okay, enough of my sermon on math and learning and trading. My guest today is someone who probably knows more than I do about all three. And he's definitely met more real-life market wizards than I have. Edward Egilinsky is the head of alternative investments for the ETF provider Direxion. Since we're going to talk about the multiple uses and risks of leveraged and inverse ETFs today, I want to make sure we are grounding our education with an expert. Let me share a little bit more about Ed. He is also head of sales and distribution for Direxion, where he focuses on global product implementation within the institutional and tactical client segments, as well as promoting ETF education and strategy throughout the financial industry. Prior to joining Direxion, Ed was managing director and head of alternative strategies at Ridex Investments, where he established Ridex as a recognized leader in alternative investments. Ed graduated magna cum laude with a BA in biology from the State University of New York at Albany. Ed, welcome to Mind Over Money.
Thanks for having me, Kevin.
Obviously, I appreciate your science background, but tell me, how did the biology major end up in finance?
It's interesting, and it involves also indirectly the turtle story. My sister, who is an attorney, at that time was working for a firm called Kenmar, privately owned firm, multi-manager commodity pool operator. I was debating whether to go to med school. I wanted to take a year off. My sister introduced me to who became my mentor, who was at Kenmar. And I joined Kenmar and took all my licenses. And within a year or two, I became pretty notable in terms of the alternative investment space. Back then, even the most sophisticated financial advisors were mostly long only, equity money managers, maybe some fixed income. So when I came in talking about commodity trading advisors, technical trend following, momentum driven, and I was marketing the likes of Richard Dennis, for example, Paul Tudor Jones, Monroe Trout, a lot of those individuals mentioned in Market Wizards. So it was baptism by fire, and 30 years later, a little less hair, still in the alternative investment space, now more on the liquid alternative side with Direxion.
Very cool. So give us some background on Direxion. And by the way, I got to tell you something funny. So Direxion is spelled like the word, but take out the CT and put an X in there. About 10 years ago or so, I was talking to a colleague and I kept pronouncing it Direxion. And he's like, "Hey, dummy, it's Direxion. Like, don't pronounce the X." I'm like, "Okay, I get it." So tell us about Direxion, and then, what evolved here? What success have you had with leveraged and inverse ETFs?
First of all, if it's any consolation, Kevin, when I was interviewing 13 plus years ago at Direxion, I called it Direxion also. So they liked me a lot and said, if you're going to get the job, you got to pronounce the firm name right. So just to let you know on that. By the way, the X within Direxion is a power symbol, of course, for leverage. So it's a play on words, really. And to just segue into what Direxion does, as a lot of your viewers know, we have a lot of short-term trading vehicles, whether bullish or bearish, on different broad indices, sectors, international equities, individual countries, and most notably, or most recently rather, leverage and inverse single stocks on right now 16 pairs, including the Mag 7. So this is a way really for somebody that wants to express a short-term view in a packaged ETF. So you don't need to be concerned about margin. If you want to short something, a lot of your viewers may not have that ability to do, depending on their account. So here is a way, whether you're bullish or bearish, with different levels of magnitude, anywhere from 3x to inverse 3x to non-leverage inverse 1x. Here's a way for traders to take advantage of short-term price movements, regardless of direction, no pun intended. And Direxion's been around since 1997. We've been doing leverage and inverse ETFs since 2008. I've been with the firm now approaching 14 years. So most of our 100 plus ETFs are bull and bear pairs tied to some index or some single stock.
And I just want to clarify for people, because I throw around the words inverse and leverage. You could have an ETF that is just inverse, but not leveraged. What are some of your most popular inverse ETFs on an index or something that's not leveraged?
SPDN, which, as you just said, is an inverse on the S&P 500. So, for example, if the S&P 500 is down 2% in a given day, SPDN would be up 2%. We also have non-leveraged inverse ETFs on all of the single stock ETFs. So we have all of the Mag 7 and other single stocks as well. We have pairs of those, 2x bull on the long side, non-leverage inverse bear on the short side. So when you're thinking of the non-leverage inverse bear, Kevin, a lot of people want to utilize it as an outright short. You're going to be less wrong because you don't have the leverage associated with it. But we do have some clients, if they have embedded gains within those single stocks that we have available, among them the Mag 7 or the S&P 500, it's a potential way to hedge without necessarily having to sell particularly in a taxable account.
Yeah, that was going to be one of my big questions, because I basically, I didn't discover this, but I sort of stumbled on this middle of last year, that, for instance, we have a large gain in NVIDIA. And I thought, well, I don't want to keep trading in and out of that. How can I trade around it without using options? And you guys have the NVDU, which is the is it double?
That's a 2x bull. That's a 2x bull. But the non-leverage inverse bear, and I think this is what you're referring to, is NVDD. So that is the non-leverage inverse bear for somebody that may want to hedge their gains in the common stock NVIDIA, or want to take an outright short. Now, despite the fact that there is no leverage associated with it, there's still going to be compounding. We'll talk about that later. All of our vehicles are designed for short-term active trading. So you have to monitor these on a day-to-day basis, Kevin. And if you want that hedge to be pretty consistent in terms of whatever beta you're looking for, you want a 1-to-1, do you want a 0.5 beta? You're going to have to reallocate every so often to keep those percentages of whatever that hedge you want on. So somebody's going to have to be vigilant in terms of monitoring that on a day-to-day basis to keep whatever hedge you're looking for.
Great. I'm glad you clarified that, because you were talking about using an inverse product as a hedge, for instance, against something you have a gain in the Mag 7. And I'm looking at it more like, I want to hold my core position and then swing trade around it by buying the dips. So that's where I use something like NVDU. And I'll tell you, one of your most successful products, at least in when I think of Direxion, is the triple leveraged bull for the semiconductors, SOXL. And then the inverse of that, the 3 times bear, is the SOXS. And when I use these, for instance, you're not like, I've been trading for 25 years, but it doesn't mean I'm always going to make money. So what I tell my people is, these are trading vehicles, and if we're not right away, we're probably going to get out. And so I had this experience recently where I was looking to buy dips in the semiconductors using SOXL, 3 times upside in the SOX index, and we were wrong. And so I'd have to get out. And what I always remind my people is, we don't accumulate these we're not averaging down because of some of the inherent characteristics. So explain to our audience why these are just trading vehicles short term and not investments that you accumulate over time.
Yeah, these are definitely short-term trading vehicles and not buy and hold vehicles, as you said. There are a number of reasons why. The first and most notable, and it's right in the name of the funds, including SOXL and SOXS, is the magnitude of leverage. It's triple leverage in this case, whether it's on the bull or the bear, on the NYSE semiconductor index, and it's going to track for any given single day that whatever multiplier it is, in this case 3x. But the key is the word daily is in our funds. Why is that? Because there's a daily reset of the leverage at day end back to 3x. So we'll track for any given single day. But once you own it past one day, there's going to be compounding. And that could work for or against you depending on the underlying path of the index or single stock that it's tracking. So the trend is your friend in this case. I'm sure a lot of your viewers have heard that analogy before. So just to give a simple example, and let's keep it simple from a math perspective as well. If I invested $100 in, let's say, SOXL, and the first day the underlying index was up 5%, and I'm investing in a bull fund because it's SOXL, well, that was a good trade for me. My $100 went to $115. Why is that? The underlying index is up 5% times 3. That's $115. But unfortunately, on day 2, the semiconductor index is down 5%. So I lost 15% on day 2. I'm not back to my original investment after 2 days. I'm under $100. So I'm actually at a loss. Why is that? Because of compounding. I lost 15% on $115, which was my starting point at day 2. And as a result of that, I was below $100 to be exact. I think it's $97.75 after 2 days. So the one thing you want with our vehicles is something to stair step in your direction. And these are timing vehicles, as you said, Kevin. The longer it takes for your narrative to play out, the more likely it is that you could experience losses. So on the flip side of that is, how does the leverage work for you? Well, in the same example I just gave, on day one, let's say you have a bull fund. Again, the underlying index is up 5%. You have $100 to start. You go to that $115. But on day two, the semiconductor index is up another 5%, the underlying index, the second day. So there the compounding works for you, because after 2 days, you're above $130. You're at $132.25. So you're up more than if you just added up the 2 days together, because you can't do that because of compounding after 1 day. So in one example, choppy market, up 1 day, down the same magnitude the next, I'm below my initial investment. The flip side is the trend worked for me 2 days in a row. And as a result of that, I actually exceeded what the 2 day times by 3 would be. In that case, a cumulative return. So you really have to, your viewers really have to be cognizant of this, that you want something to stair step in your direction, and you have to have a sell discipline, Kevin, like you said, with these type of trades. Because if you just let them go and you're on the wrong side of the trade, that decay of the compounding when it's not going your direction could really magnify losses.
Definitely, yeah. One way that I try and illustrate that to my followers is take, a 3 times bear, that ETF that has just been on the wrong side of the bull market, right? And look at a 5-year chart. And what you'll see is that you'll see a high a long time ago that will never be reached again, because sometimes what happens with these, especially with the inverse ETFs in a bull market, is that they have to end up doing a reverse stock split. And so, I'm like, we're never going to see those highs again. It's a different product. So just like you say, it's a different, because of the rebalancing, you start over. Yeah, the compounding really makes a difference. I want to talk about the success of your new single stock products like AVL for Broadcom, AMZU for Amazon. I've traded them both, and I really love the idea, because I remember when I was working in Chicago years ago, and they were trying to bring up single stock futures, and there was just some trouble with adoption. They weren't taking off with institutional clients or retail clients, but now you guys have brought these on, and it seems like it's going to be a winner, right?
Yeah, I mean, the franchise itself is over $6 billion right now. Probably the biggest assets right now are TSLL, which is the 2 times Tesla. We can talk about that a little more. It's timely. Tesla's earnings are coming up. And also NVDU, which is the 2X bull on NVIDIA. But we're seeing interest in the bull and bear, whether it's the 2X bull or the non-leveraged inverse bear, in the suite of leveraged and inverse single stocks in general, especially in the Mag 7. And even Palantir, for example, is one of our largest ETFs, PLTU, which is the 2X bull on Palantir. So there's a lot of interest on single stocks. It's really the next evolution of what's happening in the leverage and inverse space. The other thing, Kevin, to keep in mind is these are ETFs, as your viewers know. Your liability is limited to your initial investment. These are high risk reward vehicles, but in the case of, if you're an inverse ETF, you don't have the unlimited liability. You can only lose what you put in. So I think that's important for people to note, especially that have maybe shorted before and had unlimited liability, unfortunately. So these are packaged solutions through an ETF, but people should know, again, high risk reward.
Yeah, and so you've got products in different market areas too. Like you've got for the gold miners, you've got Dust and Nugget, which are still pretty popular, right? And then you've got for treasuries, if somebody wants to have leverage on treasuries, you've got TMF and TMV. Have these still been pretty popular? And are institutions using them? or are retail customers in here too?
Yeah, let's take them one at a time. I think it's a combination of retail and institutional clients, particularly hedge funds or high velocity traders, prop desks, asset managers who are tactical, and then what I'll call sophisticated retail. They may be doing other types of high risk return type of strategies, such as options or futures or crypto. So we tend to see the same type of sophisticated retail client that uses some of those other types of instruments gravitate to leverage and inverse ETFs as well. You mentioned TMF and TMV. That is triple leverage bull and bear. TMF is the bull. TMV is the bear. Keep in mind, in this case, the bull and bear, in the case of a bull, just to remind you viewers, it's bullish on the bonds. So there's inverse relationship. You're looking for rates to go down on TMF. And that is based off of the 20+ year treasury. We actually use TLT to get the exposure and what's called swap on TLT, which is just the derivative used to obtain the leverage. And the bear is an inverse of TLT and swap on TLT as well. So if you want to trade short term on the treasuries, the 20+ year, whether it's around Fed minutes, whether it's around economic data, here's a way to trade that based off of headlines or on technicals, for example. The gold miners, which is just basically a play on the basket of gold mining stocks. Some of you might be familiar with GDX or GDXJ. We have 2x bull and bear versions of GDX and GDXJ using or tracking that underlying index for both. They do behave a little differently than gold itself, the physical gold. This year is a case in point. Gold miners is roughly up double what the physical gold is up. Last year, the reverse took place. So if you want to own the gold mining stocks, in terms of trading rather, Barrick, Newmont Mining, some of those might come to mind. Here's a way to play it bull and bear. What's interesting, though, is that gold miners have had such a tremendous up year right now. One of the few areas that's been positive is that we're seeing selling in the bull products, Nugget and JNUG, and we're seeing more buying in the bear funds, which is Dust and JDust. So we tend to see sometimes contrarian type of trading where hopefully people are taking profits if things are going with you. And if people feel that the market's extended too much one way or the other, in this case, they use some of our 2x inverse products to either hedge or take short-term trades.
Very good. I'm glad you talked about that. So to comment on the interest rate products, I'm glad you reminded us that those are based off of TLT, which is a super liquid ETF. So there's so many new ETF products these days, and you want to know, okay, well, what's it based on? Is it based on some arcane index that nobody knows about? And in this case, TMF, which is the 3 times bull on treasuries, and TMV, which is the 3 times bear, they're based off of TLT. And that's
they're based off the index that TLT tracks. So that's
gotcha.
How we're getting the exposure to TLT.
Gotcha.
The TMF rather, through TLT and swap on TLT on the bull and just inverse swap on the bear, which is TMV. So those are tracking the underlying 20+ year treasury index. How do we get that exposure? We're getting it through TLT and derivative on TLT for the leverage.
And then on the gold miner ETFs, I can see you were talking about players having different views and how they trade those, and I can totally see that because I've looked at, for instance, there's a standard gold miners ETF basket from Van Eck called GDX, and sometimes it doesn't track gold very well. And I always looked at it like, well, does that mean the miners are doing forward sales hedging, and so they don't really capture the same upside that gold does? And so I can see how players would have a lot of different views there. So, I mean, we've covered a lot here. We've looked at the math and the double-edged swords of these ETFs, and I'm glad you explained compounding as well as you did. I want to close out by looking at the education resources that Direxion has on your website. I've searched for some stuff, and then I also was alerted that you have a video series called Understanding Leverage in Inverse ETFs. And that would be a great place for anybody who's going to consider trading these products to start, right?
Oh, without a doubt. We have on our website, if you go to Direxion.com with the X spelling, you can look. We have a dedicated Leverage and Inverse Education Center. And amongst what you're referring to is the video series. And I really would start with that. It's a 6-chapter series. They're videos that range from a couple of minutes to maybe 6 minutes at the most before anybody decides to trade our ETFs. I think they should refer to our education center and really get familiar with the mechanisms of how leverage and inverse ETFs work. There's other good content there as well, Kevin, Direxion University, which is really an online course that'll go through some of the things that you need to know if you're going to trade leverage and inverse, including the risks associated with them. Because again, these are risky vehicles and they're timing vehicles.
Yeah, great. I'm looking at the website right now, Direxion.com/leveraged ETF-education. And I see all this stuff here. The video course for people who just, hey, tell me the story. And then I scroll down and I see the Direxion Leveraged and Inverse ETF University. And it says here it's a course that can be completed in one sitting, half hour to an hour. So for people who like to, sort of quiz themselves, that seems like a great tool too.
Yeah, without a doubt, definitely. And I'd recommend that certainly before they consider trading.
And one I just stumbled across, I haven't watched this yet, but you've got a video called Trading the Ups and Downs of NVIDIA. So I'm sure you explained there the different strategies that can be used with the bull and bear ETFs, right, on NVIDIA?
Yeah, it's more geared probably towards the mechanisms of how they work and where traders might consider utilizing them. One of the things we try to remain is agnostic in terms of the direction of the market because we have bull and bear products. So certainly we'll provide different scenarios of how maybe some people are using a 2x bull or a non-leverage, in this case, inverse bear. You mentioned market wizards at the beginning. Of course, futures, the ability to put up a small amount of margin to get a lot of leverage, for example, exposure. In the case of some traders with us, some might consider using portable alpha. What does that really mean? Let's say you have a 2x S&P product ETF of ours, let's say SPUU, and then you want to take 50% of the exposure and put it in maybe other asset classes. Some sophisticated traders, institutional clients, from a short-term perspective, may put up only 50% to get 100% exposure and then put the remaining cash into other types of maybe non-correlated strategies. But again, you got to monitor that day to day and rebalance accordingly. But that's just another way that people might utilize the strategies.
Yeah, for sure. Anybody, when you say sophisticated and, what I try to explain to people is that, markets are very liquid and they move fast. And what some of the fast money is able to do is they're able to automate their risk management. They enter a position at a certain level and then they know where they're getting out, either for a profit or a loss. They don't get emotional about it. They don't get attached to it. They just execute quantitative strategies with rules. Basically, yeah, that's what I try and teach is like, you got to have rules for all of these leveraged or inverse products, right?
Yeah, you should have some discipline, whether it's based on fundamentals or technicals or a combination of both. Kevin, when you look at our products, there are periods of time if the underlying index doesn't have a discernible direction, there's a lot of volatility up and down, and the index is plus or minus a couple of percent over a period of time, our triple leverage, for example, bull and bear could both be down of that same underlying index over a period of time. So that could happen.
That's an excellent point. Now, so is that, we talked about how compounding works for and against you in markets that are trending, but in a sideways choppy market, you can get hurt too. And so I think some of your education stuff goes over that, right?
Yes, it definitely.
Because I saw one video that used an old example from the Great Financial Crisis. It's called Volatility Matters. And even though that example is from the Great Financial Crisis, when we have tremendous volatility, the lessons still apply. And look where we are now. We're in some major volatility where yields are spiking, the dollar's going down, stock market's going down. And so we're sort of in that environment now too, where we can see big daily swings that can make a big difference in returns.
Yeah, without a doubt. How about intraday? Look at a couple of weeks ago. You saw some of the biggest intraday moves historically. You also had commensurate volume that were historic levels, including with our products. And you probably had the top 5 in terms of the NASDAQ or S&P on a percentage basis for a given day, 2 weeks ago, Wednesday, I believe. So you really have to be vigilant in this environment, especially. You need to monitor our vehicles daily. You got to be looking at the screen. In this environment, you probably can't move away from your screen for any period of time. That's how fluid the situation is, especially with any sort of potential tariff news that can swing the markets one way or the other.
Well, Ed, this has been a fantastic discussion. You've brought a lot of expertise to understanding these products and how investors need to, they've got to do the math, and they've got to understand the compounding elements and, the double-edged sword nature of leveraged and inverse ETFs. I just want to remind my listeners that Ed and I talked about a lot of the education resources from Direxion on their website, and I'm going to link to at least 2 or 3 of those in the article version of this podcast on Zacks.com. I really appreciate you taking some time, and I hope to have you back on the show again soon.
Yep, great being here. Look forward to being back. Have a good week.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.